What you are looking at here is my 100% equity-based covered call ETF portfolio filtered by the price performance on the right-hand side. Now, for the skeptics out there, that might seem like an oxymoron. Price performance from covered call ETFs, I thought those things were supposed to, evaporate into oblivion, get grounded down to nothing, NAV erosion, capital erosion, whatever you want to call it. But as we pull back the veil on covered call ETFs and we get deeper into how these strategies actually work, you can find some pretty amazing price performance, stable distributions out of them to really get a really amazing mix of both. And that is what I'm trying to do with my own strategy. Two big ideas, they are the core of everything that I try to do, which is natural price appreciation and stable, predictable dividends. So if you like that idea and you are, say, an American or someone who wants to invest in American covered call ETFs, by golly, this video is going to be for you, so stick around because we're going to be looking at some funds with some maybe surprising price performance and stable distributions as well. Now, again, this column over here, price appreciation, if you include income into it, this is my total return for all these individual funds. These are Canadian covered call ETFs that invest primarily in the American stock market. And now we are fortunate in Canada to have the best of those two big ideas that I talk about, which is price performance, and we get incredibly stable distributions up there. So hopefully more to come on the American side of things. I think if a fund manager can really crack the code and have those absolute stable distributions that don't change month over month, I think that they're going to be in for quite the AUM hike if someone can figure that out. And anyways, let's get into those funds. Anyways, everyone, these are the 6 funds that I've picked out for our coverage purposes here. These are funds that I like from just a price performance level and also a distribution level. So we're going to primarily, of course, focus on the performance. We'll focus on the distributions, and we'll kind of look at a few other metrics as well. What you're currently looking at here is what's called the covered call ETF AllStar tracker, a spreadsheet I've created with the Canadian tab down here. And also a US tab with all these various other tabs that will give you quite the insights into covered call ETFs. There's probably 250 plus funds across Canada, the US, here in this tracker to consolidate everything down so that you can make confident and informed decisions about your income investing needs. And if you want it for yourself, you can get it on my Patreon in the description below or the first comment that you see. It should be a pinned comment. But enough of that. Let's get into these 6 funds. Now, I'm not going to go elaborate in great detail on all of these funds. I would say 5 of these funds more or less use a pretty standard covered call strategy where they write a particular percentage coverage on the portfolio and extract income that way. ISPY is probably the only one that is different amongst the crowd. I did want to put in a fund that did use daily call options just to see what it would look like. And this one is probably my favorite out of all the daily call option stuff. The gist of it really is, what makes it unique is that it does own its underlying assets, which is not normal for that crowd of funds that invest in daily call options. So this one does, and then it uses call spreads and futures contracts to get a return, and it uses those 500 S&P 500 positions to use it as collateral to get the return if something goes awry. I do have a video, I'll probably somewhere around here, I'll overlay what that looks like. The description will be, or the link will be in the description below for a much more detailed overview of what ISPY is from my perspective. But anyway, all these other funds, pretty standard covered call funds, which I like. I like simplicity. It is my favorite thing in the world. Please, 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 please continue to make simple funds that just do simple things, easy to understand, and especially for us, normie investors, normie retail investors. Okay, so we move across. All of these mimic an index like the S&P 500 or the NASDAQ 100. We get definitely some different yields in here, from 15% all the way down to the 7% range. If we go, how high off their 52-week high are they? This just column, just again, it's the discount off the 52-week high. We can see everything is pretty close to their 52-week high, so it's not like there's any real big discounts as of the recording here on Saturday, September 21st. But as we move along to the main sequence of performance here, or one of the main big ideas, we can see that performance among this group of funds has actually done really well. So this is the column that hopefully gives, especially over the course of time, 5, 10 years, as I continue to track these funds, gives you the confidence to invest in them. Again, ideally, at minimum, we want it to naturally outpace inflation, bare minimum. And so far, at least this year, these funds, let's just go return year-to-date price performance. I mean, for the most part, all these funds have I'm sure would kind of shock you with their sort of natural price performance. Even though the S&P 500, the NASDAQ 100 hovering around the 20% range. Again, if you're invested in these funds, if you're doing it because you want to try to beat the market, you are in the wrong place, my friend. We are here for the income, to use the income for various purposes, whether it's to reinvest or capture some of those distributions to put into other funds that maybe you want to average down in. Whatever your reasons are, this beating the market is not the right place for you. So here we get some great price performance year to date, 13% from BALI, 10.884% from GPIX, and then again we get about 6.5%, 6.56% from SPYI, and then on a total return basis, if you were to include the income, crazy that BALI is like keeping up with those main indexes, and even still, I mean, even for a short period of time, you figure you don't need the income, but you want to keep the funds, reinvest. I mean, you're still getting, it's still crazy, 13.5% in my eyes. That's still a great return. I typically don't want to get bogged down by language like, it's underperforming the market. I mean, whatever your plans are, that is what should matter the most, not necessarily that I'm underperforming the market, right? If you have a locked-in strategy, and you're okay with, potentially I might underperform the index, that's okay. I'm using this for income, then hopefully that doesn't matter as much. But many of these funds too, which is crazy to me, are going to be outperforming even traditional mutual funds that you probably think are like the most amazing thing in the world. It's like a lot of these funds will just shatter the glass on all of that. So on a price performance level, it's doing what we set out to do, which is we get some natural price performance in pretty much every single month that we are tracking these funds. And then moving across the board, just to understand these strategies just a little bit better, we got a gross fee with the Goldman Sachs and BlackRock at 35 basis points. I mean, this is pretty standard for the bigger entities, bigger financial institutions. They certainly can afford a smaller AUM so that they can grow their own AUMs. ProShares, Neos, a little bit smaller, well, a lot smaller. So, you're going to see more of a typical gross fee from these guys, which is in that 0.65 range, 0.55 range. And remember, that's all costs in for gross fee, right? Here in Canada, we go by management expense ratio, which is basically the same as the gross fee on the American side of things. And then we get the coverage. I find on the American side, they're much more liberal with their portfolio coverage. They really want to give themselves maximum flexibility. Whereas on Canada's side of things, you'll see things like CoveredCall coverage, maximum 30%, maximum 50%. But Americans, just like the state of Texas, go big or go home. it's whatever. It's just up to 100%, 25 to 80%, up to 80%, which does help with keeping distributions stable. They can write more. They can write more on the portfolio, again, to keep that distributions fairly stable. So let's actually, you know what, I do have a section here on distributions. That's more of a quick overview, but let's actually go down to the tab that is the distribution tracker and see how these distributions have been growing over time. Now, with all of these funds, minus ISPY, they have grown by decent amounts this year. And what is great about CoveredCall funds that focus more predominantly or allow for price appreciation is that even though you're starting potentially with a smaller yield over time, no lie here, is that you could potentially see yourself with a yield on cost of, let's just say you start with 10% as a yield, and the fund naturally grows 5, 10, 15. You could find yourself with a yield on cost of 11, 12, 13, 15, 16%. It'll naturally grow over time. So the big reason for this is that as the price of a fund grows, if a fund manager is writing basically the same amount, the same coverage on it every single month, well, that coverage is now going to start to, it's going to start to decline. So if a fund manager has always been writing 30% on a fund, but then that fund naturally grows and they're trying to maintain that same amount of coverage, well, it'll naturally drop to 25%, 22%. They have to, if they want to try to keep a coverage ratio closer to that 30%, they're going to have to write 30% on a fund that has increased in value, which will then push up the distribution. So even though you might see that maybe 10%, 11%, that's not your game, you want something a little bit higher, but if you're willing to wait, get a little bit of natural price appreciation, it's a great psychological win as well when you see, you know, your portfolio naturally going up, especially over time. If you want to sell it off, well, you can sell it off and make a little bit of money on it, especially while you collect the distribution. There's a lot of positive psychological wins with all of that. And so as far as stability is concerned, year to date, all these funds, minus ISPY, unfortunately, has they've all seen really predictable, stable distributions. I would say, like, let's just start with BALI, for instance. It started February at when I started recording it. Some of these funds might actually be older. I want to say BALI, its inception date was, I think, October of 2023. But I only started tracking everything in January. So that's when the CoveredCall tracker came out. So I haven't been tracking anything prior to January 2024. And that's when I started adding American funds, which was in February of 2024. Anyway, so with BALI, I mean, it's up 10%, down 21%, up 33%, down 33%, up 30%. I mean, I would say as far as distribution stability, it's definitely on the rockier side of things. Overall, it's grown it. So, I mean, with BALI, it's kind of, if you don't mind this kind of action, much more volatile in its the way it's paying out its distributions. But on the plus side, it's one of the best. It's the best total return performer of all of these funds. All right, so if you want something with a little bit more stability from, say, something like the NASDAQ 100, well, look no further than GPIQ, which is it's a stock selector, meaning it invests in a core of NASDAQ 100 stocks. And so it tries to more or less replicate the exposure, but not necessarily investing in the entire index. So what you can see here with GPIX is that we've gotten 9.19 distribution increase year to date. Now, by the way, there might be a question of, like, why is September not in here when you're filming in September? The reason for that is that when it comes to updating this tracker every single month, On the Canadian side of things, we typically get the distribution information, say, at the end of the month. So for September, I'd get all that information at the end of August, and which would be in this tracker. But on the American side of things, it's kind of all over the place. So I have to delay that by about a month, but I am currently working on ways where I can get live data immediately once that information is released. So still a bit of a work in progress that way, but still there's obviously other great information in here to help us make more informed, confident decisions with our income investment strategies. So again, with GPIQ, not quite as volatile as BALI with those distribution increases, decreases. Kind of more or less maintain sort of maybe an average of 3.5–4% roughly month over month, if you can at least stomach that. GPIX by Goldman Sachs, the overall distribution increase, not as much, kind of close, but let's see what we get. It kind of looks a little bit similar overall, maybe average 3% of change month over month. And then we get into NEOS, which let's just see for the NASDAQ 100 High Income ETF. Once again, more or less maybe within that average 3% range. And then we'll just maybe finish off with SPYI, which has one of the bigger increases overall year to date at 13.64%. And where did that start off with? I think it probably has the narrowest band of stability. 1.41%, less than a percent, down 2.47%, up 2.24%, 1%. And then obviously between July and August, there was a lot of volatility in the market. So we see it ratchet up 9.31%. But I suspect come September, or once I get this info into the October tracker, it will probably come back down to maybe this 50-cent range that we've kind of been consistently seeing, 48%, 50%. So in my opinion, as sort of the final closing thoughts, if there's any fund in here that I'd be really interested in investing into on the American side of things, it probably would be SPYI. I like its stability. I like that it has the natural price performance that it does have. Right, you get over the course of 1 year, even if you were to reinvest 14%, that's nothing to sneeze at. You're beating many other, not just ETFs, other types of funds out there that don't have covered call overlay strategies, and they're doing worse than this. So for a period of time, if you want to take the income, then reinvest. I think it's great in that sense. 13% yield, that's roughly in a range that I'm really happy with. I try to go for in the 10 to 12% range, but even my yield on cost is upwards of 13%, even in a short period of time that I've been invested in covered call ETFs, which has been about 2.5 years. That yield on cost is now up to 13%, which maybe I'll put something on the screen here just to show that. So hopefully you all enjoyed a video like this covering the American covered call ETF landscape with price appreciation and stable distributions. Hopefully you learned something from it, and you may continue to make educated, well-informed decisions. Hopefully the content helps in that way. So if you like what you saw, as always, do the cliche thing and hit all the buttons of like and subscribe variety. And I'll see you in the next video.